In today's episode, we're going to discuss SPACs, risk parity, and NFT, or non-fungible tokens. Over the last 22 years, one of the things that I've noticed is that Wall Street comes up with some great financial jargon that not everybody understands. And at the same time, I've been getting a lot of requests from people to explain different terminology that they've been hearing about in the media. So we're going to start something new where occasionally, when there's some hot topics in the media, we're going to break them down and we're going to take the financial jargon you may be hearing about and simplify it so you understand what the hell these people are talking about. So, Mr. Singletary, in the last few weeks, there has been a lot of conversation in the financial media. If anybody's watching CNBC or reading any of the financial news, they've been hearing about something that has been very popular, big investment, all kinds of people are doing. It's making people feel like, oh, we're making fortunes in these things. What do you think I'm talking about? What's been in the news that would make you feel what I'm talking about?
That would be the SPACs, or
Yes.
Special Purpose Acquisition Company.
Woo! Special Purpose Acquisition Company, a SPAC. So it is not something, it's not a utensil in your kitchen, all right? SPAC stands for, it's an acronym, right? You know you've arrived on Wall Street when they give you an acronym. It's like, you won the pledge. Special Purpose Acquisition Corporation. Justin, do you know when I first saw these? How long ago?
Probably quite some time ago, but they've just renamed it.
Yeah. So what people have to understand is Wall Street has a long history of taking something old, repackaging and relabeling it and bringing it out as something new. We used to call these reverse mergers. Sometimes they were called RTOs. At the end of the day, what it is think of this. When a company is young and it needs capital to grow, it's got to raise money from investors. Now, one of those ways you can raise money is to go do an IPO, become an initial public offering, get listed on a stock exchange. Here's the thing that you have to understand. If you want to list your stock on the New York Stock Exchange, you've got to jump through some hoops. The New York Stock Exchange isn't going to let any schmuck just list their company. So you have to prove to them that you have finances, that you have a real business, that you're doing what you say you're doing, right? The NASDAQ has different listings. That's why there's a difference between New York Stock Exchange listed companies, NASDAQ listed companies, and the pink sheets. They're all different hurdles. So where I'm getting at with this, Justin, is that a young company that's really more of a venture capital company, right? They need capital to start to prove themselves. What's happening right now is those companies are actually becoming IPOs. They're getting listed on these stock exchanges without having to go through those hoops. And do you know how they're doing that?
Through the Special Purpose Acquisition Company and/or Blank Check Company.
Yes, yeah. So that's why it's special purpose, right? The special purpose of getting this company public and out there and get a lot of people invested in it. So what investors need to know is that this process is part of the sideshow of the euphoria that's happening in markets right now. SPACs and reverse mergers and all these things happen when there's more money chasing a lot of bad ideas. And while there are going to be some very successful good SPACs, there's also going to be a lot of miserable SPACs as well. So investors need to be very aware of doing due diligence if you're approached to invest into a SPAC, because I would say, like most things in life, 80% of them are going to be dog crap and 20% of them are going to be good. And how do you know the difference? Are you armed with the knowledge and understanding of knowing the difference? And I get it. A lot of people, I mean, when you've heard about SPACs, Justin, What do you feel? I mean, are you hearing that people are making a fortune? What,
Yeah, so there's no, not there's only a few people that are making a fortune, and a good example of one that perhaps some people did make some money in would be DraftKings. So
Mm,
DraftKings was listed public or went public, I believe, last year. If not, it was at some point in late 2019. But nevertheless, the reason or how they were able to go public was through this particular vehicle, was through a special purpose acquisition company.
mm,
And in 2020, there was around $64 billion of investor dollars that went towards these
SPACs.
investments.
Yeah. And here's some of the downside that people have to understand. I have seen situations where there was a SPAC put together. Now, when they put the SPAC together, it says, hey, it's going to go acquire a company in such and such industry. That's typically how they're formed. They'll say, hey, we have a management team that comes from the healthcare industry, and therefore we're going to find a company that we're going to merge and buy with the money that we raised by going public. That's why they're also called a blank check company, is because investors are putting their money into this vehicle before they're even told what they're actually going to invest in. That sounds very trustworthy, right? But essentially that's what's happening, is investors are putting this into a vehicle and trusting that the management is then going to do what they said they're going to do and purchase a company in that industry. Well, just in the last few weeks, I've seen a cannabis SPAC, a SPAC that was formed that said they're going to invest in the cannabis industry, go out and actually go buy a space-oriented company, right? So that's why I say investors beware, because there's such a fury around these SPACs that it's become one of those, if you're the unassuming, gets taken advantage of. So this is an area that people need to ask a lot of questions. Nonetheless, it's very interesting. And I will tell you, this phenomenon tends to happen when markets are frothy. And so where it's relevant to you that are listening with a retirement account that's invested in markets, is these things tend to happen when you're closer to the end of a growth cycle, not the beginning of one. So we continue to encourage people to be very careful with what risks they take at these times, because these animal spirits come and go as markets go from high to low.
Yeah, always do your research.
Yeah. So SPACs are interesting. Now, another thing that's been coming up in conversations, in addition to SPACs, has been this thing called risk parity. Now, a lot of people are just starting to hear about this, but it's something that's been going on in conversation for at least a month, that we've been sharing it with people. Justin, is that correct?
Yeah, we've been talking about it for the last month, and just so you folks know, this has been going on since the early 80s.
Yeah. So in the early 80s, Ray Dalio, who's Bridgewater Capital, the largest hedge fund in the world, came up with this concept, risk parity. And Justin, I know when you were doing some homework, you found something humorous about it. He was doing it based on an investment around McDonald's.
Yeah, he, to not screw it up too much, but it all kind of started with McDonald's, and when they wanted to launch the chicken nuggets, I guess the price of
Do
chicken
chickens
was.
have nuggets?
Well, I guess back in the 80s, in the early 80s, the price of chicken was extremely high. So for McDonald's to launch it, they wouldn't, it would be it wouldn't be very cost effective. So what they came up with is by hedging their bets with the feed, or what they feed the chickens, which would be corn and soy. So they would go out and they would purchase what they needed for chicken nuggets, but they would also be hedging their bets with the feed or food.
Different bets on the feed futures and things of that nature. So
it helps smooth out the price of the chicken.
Got it. And this is, done a lot now in a lot of commodities, or guys that are in, that grow things for a business. They can kind of offset and hedge some of their risks in the futures markets. And so it sounds like that at the end of the day, it's the risk and the parity meaning two things, is that you're taking risk in two items that you're pairing together, and you're hoping they play off of each other. And so what's happened over the last 30 odd years is that us as money managers have pretty much come to the conclusion that interest rates have been continuously on a slide, right? And there isn't usually a lot of volatility in interest rates. So what money managers do is they'll go out and take a chunk of money and buy a large amount of treasury notes, and they will set algorithms to make sure that if those treasury notes happen to trade outside of historical norms, because what they do is they look at the past and they say, hey, if the volatility in that asset is low, they put more money in there, and then they leverage it, or they take a loan against it. And with that leverage, the money they get from the leverage, they invest it into another asset that's growth oriented and has momentum. And so that's been pretty much technology stocks. So the risk parity recently and how it's affecting you and I in markets is that these money managers, and there's a lot of them, there's tons of money that's managed in this idea of park money in treasuries, leverage it up, put money then in SPACs or momentum driven growth vehicles, Apple, Google, Microsoft, things of that nature. And if you're in an environment where interest rates are declining, then that side of the trade that's in treasury notes is very happy because it's probably making money and at worst breaking even. And then if your risk assets, the stuff you put in the stock market or other assets, is rising, you're winning on both sides of that trade, win-win. It works great until you go outside of the historical norms. February will go down in history as one of those times where interest rates went outside of the historical norms. Interest rates spiked up significantly in February. And what then happens is these money managers, they end up taking on water in that treasury bond. So realize interest rates rise, the treasury bonds drop in price, they're on leverage, so they drop in price a lot faster. And then that money manager gets margin calls that he has to meet. And so then he has to sell his Apple, his Google, his technology stocks to help support the margin calls that he may be getting. And so then we'll have a few weeks here where markets get dislocated and everybody's portfolio kind of gets in the middle of this punching of the big boys. At the end of the day, it's a temporary shift, but we have to watch markets very closely right now because sometimes these temporary little shifts can spark a domino effect if they get too big. So that's what's got markets a little riled up and why over the last week or two, you've seen a sell-off in the NASDAQ that's been greater than any other market. It's this unwinding or readjusting of this quote unquote risk parity trade, which at the end of the day is rich money managers playing two assets and trying to make as much money as they can. And in February, they got their ass handed to them. And that happens once in a while. So that's risk parity in a nutshell. Anything else we should add there, Justin, or did we pound that one?
Covered it.
All right. So risk parity, you'll hear about it again. It's done in a lot of different ways. They got yen trades, this trade, that trade. So risk parity. I think what's even more fun is the next subject because we covered SPACs. We talked about risk parity. Now there's this whole craze, all these influencers and social media and people that I would consider are like early adopters to things. And then all these people that are like friends of finance, I would call them, the wealthy that are always kind of in the early phase of things. Like I'm hearing Mark Cuban talk about this stuff. So these things that are called NFTs is non-fungible token. And all I can think of, Justin, when I hear about it is like, hey, I went to the doctor, I had a rash, he took a test, I came back and he said, hey, good news. You got a non-fungible token. Here's a cream, right? so every time I hear non-fungible token, that's where my mind goes. It's weird, I know it. But nonetheless, tell us a little bit about non-fungible tokens because you're the millennial. You're the young guy closer to this technology stuff. So tell me what you know, and I'll see if I can backfill some of the information.
Yeah, definitely. So the way to think about a non-fungible token is, so originally when somebody would create a piece of art, that art, if it was created on the, in the computer, it could have been distributed anywhere, and the person who created it would not be get paid for it in some form or fashion. So what this does is it allows the artist to create a piece of art, and the token, or the non-fungible token, becomes the artwork's asset. So the token itself is now the asset of the artwork. So now that can be traded and distributed throughout anybody who finds that piece of art or whatever it is they have there, or part of that token, that can now be sold. Now, what's great is that's the original. So, when it gets sold to to somebody else, they have, when somebody buys that token from them or that piece of art, they now have the original. So they have the original piece of art, and it gives a person a way to keep that the value of that through the coin or through the token, and people
Wow.
can't go off and make money
Wow.
through somebody else's art. So,
But it
and
protects them.
because it uses the blockchain technology, it allows you to give a digital record of everybody that has owned or sold your particular piece of art or token, if that
Cool.
makes
You know what I think is so exciting about this as you're talking about it? What was coming to my mind was, I was like, wow, this is very cool. This is that one of those new trends in my mind, because here you have something that solves a problem, right? And it doesn't create a new market. What it does is it evolves an old market. There was always an art market, like things that got traded, right? But this solves all kinds of problems. I think the biggest problem that it creates, though, is it makes a big problem for insurance companies. You would think if you insuring a piece of art should now be a lot less, based on this stuff. But nonetheless, if you're an artist, it's a great way to protect your talent, right, and your skills. And it's a great way to get paid for it and track it. And if you're an investor that happens to be wise enough and in tune with these things, because I know a lot of people that's what they love to do. They trade art, and they trade obscure tangible items because that's what's fun for them. And so if you're in one of those realms, now you've got this new market that helps protect you in some cases as an investor, and gives you better tracking, because it sounds like you can get a ledger of everybody who's owned this. It's like a glorified title report that's not centralized in any way. So I just see a lot of exciting things where I don't know where the investment thesis is right now for somebody like an average Joe like you and I, but I definitely think it's something people should keep track of over time. It's very, very interesting to watch.
Yeah, and I would add that it's pretty easy for any one person to go and create their own token, if you will.
Mhm.
There's a couple of companies out there that are pretty mainstream. Rarible is one,
Okay.
OpenSea is another one. Those are more places where people are going to try and make a quick buck. They'll just throw something together on, I don't know, PowerPoint or Illustrator and throw it up there, and but they do have some more reputable ones, probably where people have been getting the news from, where there's been some high dollar sales of some different artwork that's been sold. One of them is Nifty Gateway. The other one is Superware, I believe. But again, more reputable sites where you're actually dealing with true artists, not.
Okay, so I might be a little slow, so let me ask a question. So these are places or companies or websites, whatever they are, that the artist can go and do they register their art there? Do they do the art there? Like how does that? They register it, and then that has like an audience or something that they can then
Yeah, so
they can market it
it's
to.
all platform, driven. So, depending on how many people are on any one Rarible, or who have an account with Rarible and have a digital wallet. So if you're going on to create your own artwork and get a token for it, you would, just like you would anything else, create your own account. There is going to come costs with that,
Mhm.
to not only create the account, but then also to give yourself or get yourself a token for whatever piece of artwork you've created. And then at that point, you then are able to put it out there and people can bid on it and buy it if they
Okay.
so choose. I mean, whether they buy it for 99 cents or $100,000 is, up to you or up to the buyer. So,
Yeah.
what the market permits. But yeah, it's again, platform driven. So from my understanding, I don't know if you can do cross-platform type stuff, but once if you have an account with Rarible or OpenSea, those that have accounts there and view their items for sale, you would be able to go on and either set up and sell or go on and set up and purchase.
That's interesting. All right. Well, let's wrap it up for everybody because here's, I always like to bring things back around to why it's relevant to somebody who's saving towards retirement or has money invested in the markets. And here's where I think it's really relevant. So, things like SPACs and then dislocations or things that move outside of historical norms like risk parity, and then frenzy items, like new frenzy items that hit the uber wealthy, that would be the NFT. All of these kinds of activities in my career, I have tended to see them closer at that moment of euphoria and excitement. And that always raises my antenna because, I like to be a little contrarian here. And when I see these things, I always have to ask myself, okay, when this is happening at the same time that markets are at all-time highs, should we as investors, should we be excited? Should we be looking for ways to take on more risk? Or should we be concerned? Should we be thinking about how we preserve what we have and maybe take and harvest some gains that we've made, if that's the case? Well, the answer to that is always about time frame. So if you have questions about your retirement savings, your goals for retirement, and you're wondering whether you should increase your risk or decrease your risk, contact us, and better yet, visit us at Quiver Financial. We have a new retirement resource page that has all kinds of fun stuff on there for you if you're nearing retirement. And until next time, folks, take care. And Justin, you're happy with what we got?
Absolutely. I would say too, if you like the video or find value in it, please subscribe and give us a thumbs up or a like. Until next time.
Take care.